In this video, we're going to take a look at futures pricing. Now, ultimately, futures prices are set by supply and demand in the financial markets. You have people that want to buy futures contracts, people that want to sell futures contracts. And wherever the supply and demand meet, that sets the equilibrium price, and that's the price of the futures contracts in the financial markets. Theoretically, we could take a look at two different ways to price futures contracts. One is based on expectations theory, sometimes referred to as expectations pricing. The idea here is that the futures price should equal the expected spot price at the time of expiration. For example, let's take a gold contract. If I think that at expiration gold is going to be $1,500 per ounce, then I wouldn't want to pay $1,550 per ounce for it today. On the other hand, if investors thought that it was going to be $1,500 per ounce at expiration, they wouldn't want to sell it to me for $1,400 per ounce today either. So the price in the futures market should be equal to the expected spot price at expiration. Now, this isn't each individual's expected spot price, but the equilibrium expected spot price should set the value of the futures price in the financial markets. However, when we get into financial markets, we might see that there are some other things to take a look at. And that introduces the arbitrage pricing approach. To introduce arbitrage pricing, let's start with an example. Let's assume that you could buy a barrel of oil for $80 today. The current futures price for delivery 3 months from today was $85. How can you exploit this discrepancy between the spot and futures price in a world of no transactions costs? So, oil futures contracts are 1,000 barrels. So let's say I go out and buy 1,000 barrels of oil today at $80 per barrel. I can then at the same time sell a futures contract and agree to sell those 1,000 barrels of oil for $85. I've just agreed to sell the 1,000 barrels of oil I bought today for $85 3 months from now. So 3 months later, I deliver 1,000 barrels at $85 per barrel. I make a $5,000 profit. Now note, on this $5,000 profit, there was no risk to me. I didn't care what happened to the actual price of oil after I bought it, because when I sold that futures contract, somebody on the other side was agreeing to take delivery of that oil for $85. I bought today, locked in my sales price, and guaranteed myself a profit of $5,000. Now, in that example, we assumed a world of no transaction costs. However, let's try to move this to a more realistic setting. One contract of oil is for 1,000 barrels. What issues will I have when I try to take advantage of this pricing scenario? Well, first of all, remember my first step in the above example. I had to go out and buy 1,000 barrels of oil at today's price of $80 per barrel. What am I going to do with 1,000 barrels of oil? Can I put it in my backyard? I'm guessing my neighbors probably wouldn't appreciate that too much. However, a local thief might find it attractive and decide to come and take a couple barrels and turn around and sell them. So when I purchase my 1,000 barrels of oil, I have to worry about storage. I have to find a safe, legal, and secure storage place to hold that oil for 3 months, and that's going to add to my cost. Also, while I'm guaranteed that $5,000 profit, what do I have to do first? I have to buy 1,000 barrels of oil at $80, so I have to spend $80,000 up front. Now I know 3 months later I'm getting $85,000, but I still have to borrow that $80,000 today. So I'm going to have to borrow money and pay interest. So I've got storage costs. That storage includes storage facilities as well as security. And I've got interest. Now, you might say, well, I don't have to borrow the money. Maybe I've got $80,000 I can invest. That's true, but there's an opportunity cost. If I invest in that oil, I'm not investing it elsewhere, so I still have the interest cost associated with that. An opportunity cost of interest if I'm not borrowing the money, and a real cost of interest if I do decide to borrow the money. So the storage and interest are going to take away from my profit. If the storage and interest are less than $5 a barrel, I'm still going to be able to conduct my arbitrage and lock in a profit. If the storage and interest are $6 a barrel, now it's no longer worthwhile for me. I can't buy my oil at 80 and lock in the sales price of 85 and make a profit. Now we also might look at a convenience yield. In our oil example, we looked at cost to us of holding the physical asset, but there might be benefits to holding the physical asset. One thing to look at might be in the case of stocks where you get dividend payments. For interest, for example, if you buy index futures, the actual stocks would pay you dividends, but your index futures contract doesn't. So if you're holding the futures contract instead of the actual physical property, you're giving up the dividends. If you're holding the actual stocks, you're receiving dividends. That's going to lower your cost of holding the actual stocks because you're getting the dividend payments. Maybe it's currencies. Pretend that you're looking at buying currency futures. Maybe you want to look at buying euro futures. Pretend that in the US, interest rates are 2% and in Europe they're 5%. Well, if I actually held the physical currency, I could be collecting that 5% interest on my euros. Because I'm holding a futures contract, I don't get to do that, so I'm giving up that interest differential. So currencies sometimes have a convenience yield. We might look at commodities. Could just be a preference for the actual physical asset. For example, gold. There are some people that think the advantage of gold is in case of some type of Armageddon situation where the global markets collapse. And if the global markets collapse, while the value of a futures contract may go up, what if there's no markets to trade in? Wouldn't you rather have actual physical gold that you can get your hands on? So a lot of people investing in gold would actually prefer to own gold bars or gold coins, something physical that they can possess. That way, if there is some type of market collapse, they don't have to worry about trying to sell their futures contracts. So these convenience yields, instead of a cost of holding the physical asset like our storage and interest from the previous example, may lower the cost of holding the physical asset. When we combine those all together, what we have from the arbitrage pricing approach is that the futures price should be equal to the current spot price times 1 plus the annual interest rate, the annual storage cost, and here we're talking about the storage cost as a percentage, not as a dollar value, minus the convenience yield, and again as a percentage raised to the time. So let's say that our interest was 2%, storage costs were 1%, and convenience yield was 0.5%. And we had a 3-month position. Now remember, when we're raising to time, we always want to think of that in years, so that would be 0.25. So now let's say our futures price is what we're trying to solve for. Our spot price, in this example, let's just say is 80. So our futures be equal to 80 times 1 plus 0.02, interest costs, storage costs, and then subtract off the convenience yield, raised to the 0.25 power. Now let's do the calculations on that real quick. And that would give us futures price of $80.50. So we can use the arbitrage pricing approach to figure out what the value of a futures contract is by figuring in interest costs, storage costs, convenience yield, and how long that futures contract has until expiration. The last thing we're going to talk about in this video is some terminology that you might hear in discussing futures. Contango. Contango is just a situation where the futures price is higher than the current spot price. In our example here, our market was in contango. The futures price was $80.50. Spot price was $80, so the futures was higher than the current spot price. Oftentimes we'll see markets in contango when there are storage costs, and in many cases, especially with physical assets, that's going to be the case. Now, you might also hear the term normal contango, and unfortunately some people use these two terms interchangeably, which leads to a big confusion. Normal contango ties back into our expectations theory a little bit and says that the futures price is higher than the expected spot price. So a little bit different here. Contango, the futures price is higher than the current spot price. Normal contango, futures price is higher than the expected spot price. You also might hear that the futures market is in backwardization. Backwardization is just the opposite of contango. Futures price is less than the current spot price. In this case, the convenience yield is higher than the storage and interest costs, so that futures prices are lower than the current spot price. Normal backwardization, again like normal contango, deals with not the current spot price but the expected spot price. So normal backwardization, the futures price is less than the expected spot price. Let's go through a real quick example. Let's say we have a situation where the futures price is 100, expected spot is 101, and the current spot price is $99. Now what would we have there? Well, if we look, we have a situation where the futures price is higher than the current spot price. Futures price is 100. It's higher than the current spot. So futures is greater than spot. So our markets are in contango. On the other hand, right now, the futures are less than the expected spot, which that is our definition for normal backwardization. So here we have a market that's in contango and normal backwardization. These terms can get a little bit confusing, but that gives you a basic idea of futures pricing and some of the terminology you might hear with respect to futures pricing in 2012.